goes up, you've got the upswing. There are caps, obviously, but it's a nice 12.5% cap. And there's, worst case scenario, if the market goes down or tanks, I hate to use that word, but back in 2008, when the market lost 39%, people in these policies lost nothing because it's a fixed product.
Yep.
So it does stay level if the market goes down. You can put more money into it. We do a lot of tax-free retirement through life insurance, and the money does come out tax-free eventually because it's after tax dollars, and we can show you a way of comparing a 401k to doing this through life insurance, and you get multiple benefits by putting money away. Yes, it comes out tax-free. You have a death benefit, and you get living benefits. On your 401k, yes, it's pre-taxed. You can write some of it off. The average person puts in about $3,500. If they have children and a house, a mortgage, you might be able to write off $1,000 a year. So you do that for 30 years, you've saved $30,000 of paying on tax. Now, when you retire and you say you saved $500,000 in your retirement, and now you need $60,000 to retire on per year, well, Uncle Sam's hand is out first saying, okay, now you're taking the money out. So just say you're in a 20% tax bracket. We all know taxes will eventually always increase, never decrease.
Yep.
So if you keep that 20%, the first $12,000 goes to Uncle Sam. So you do that for 10 years, you'll pay $120,000 in tax from 65 to age 75. Where if you took that $3,500 when you were working, you put it into an index universal life, you'll have the same $500,000 or more, and it's tax-free. So I always ask my clients, would you rather pay tax on the $30,000, or do you want to pay tax on when you retire and pay $120,000? And the second question is, what if you live to 85? Now you're paying $240,000.
Right.
So a lot of my clients say, well, obviously, Rich, the $30,000, and you can stop your 401k and transfer the money in. Not transfer, leave it there because you're still working there, and use that money to put into a new policy, and it will grow for you. We review it every year, and it's just a better way of looking at, again, tax-free retirement planning, because there's a statistics out about 40% of people under 45 are not in the market. Why? They're afraid because they don't know what to do, where to put it, and especially since the 2000 from 2000 to 2009 was the worst 10 years of the market, because they lost half their money in 2008. I have a client that had money in the market 2008. He lost his shirt. He just told me about 6 months ago. He's still not even 10 years later.
That's a sad story.
It's tough.
So, Rich, the name of your company again?
Reliable-financial.com.
And the website for it is reliable-financial.com.
Yes.
And it's Rich Cohen. And what's the phone number, Rich?
973-641-6840.
And I wrote it all down this time so I can say it myself for you. So I think one of the traps that a lot of people get into, because I know we did, was you've got life insurance from work. Now today we don't pay benefits the way we used to, but I always had like double or triple my salary in life insurance. So let's say, round numbers, I was making $100,000 and I had triple, so $300,000 life insurance. I tend not to carry over life insurance, or maybe something that's running, but not go out and buy more when I should have bought more. But then the ultimate problem comes along and you either get laid off or it's retirement time. Now, if you get laid off, it goes away, and it's very expensive to get insurance the later in your life. Or if you retire, instead of getting free times, you probably got a half of your whatever. It's 1/6, 1/5, 1/4. How do people hedge themselves from getting into that trap?
Well, years ago, I used to get that a lot. I got life insurance from my job, Rich. And I said, that's great, but you don't own it.
Yep.
Okay? You leave,
it stays.
You get fired, it stays.
Yep.
And it's either 1 times your salary, the max, unless you're higher up in corporate life, and then you're talking a lot, 1, 2, or like you said, 3, maybe possibly 3 times. Then you can buy voluntary, and it's cheap, but it doesn't have the living benefits, critical and chronic care, that on our policies. It's always good to own something, like we own our homes, we own our cars. You want to own your own insurance so you can control it, okay? Because what happens if the company goes out of business? Well, there goes your life insurance. I have a client, fairly new client, that he was putting money into. He bought a policy through the company, putting a lot of money into it, and the company went belly up, and he took years to try and track it down, and he lost a lot of money. They took the money. They never even paid his life insurance. They just put the money in their pocket.
So let's take a typical person. My average customer, from real estate viewpoint, buys their first house at around 30 to 35 years old. So let's say 35 years old, guy's making $75,000. He buys a house. This is the perfect time for him to be buying the insurance at the same time. What would insurance cost for somebody 35 years old, good health, earning $35,000? I know it depends, but just a round number.
It does vary. I mean, you can get someone like that can range anywhere from $30 to $50 a month.
Okay, so it's not big. It's
early on. If you're getting mortgage term, no, it's inexpensive.
Right.
Okay, even if you do the permanent insurance, that's the best time to get it because you're young. You have 30 years for it to grow. And, you can overfund it. You can put more money in it. You can borrow money out for college. You can use the index universal for a lot of different things, not just for retirement, not just for life insurance. We do use it for college planning, college funding, for when, even for young children, a good head start. $50 a month for a child, get some $50,000 policy. We're not doing it for the death benefit. I have children as well.
Right.
And I don't want to collect on my children's death.
Right.
God forbid. So it's about giving them a head start. Like you mentioned earlier, Gerber Life. $20, $10, you get a month, $10, $15, $20,000. Nowadays on this index universal, you do this for somebody, for a young child, and when they retire, if they just keep taking it over from there, it will snowball, and they'll have quite a bit of nest egg.
Well, let's just talk about college. If you started a policy on your grandchild when the grandchild was born, and you put $50 a month into it, now that's $600 a year. Over 10 years, that's $6,000. 20 years, $12,000. What is a policy like that worth when they're ready to go to college that they could borrow against?
It will depend on the face amount.
Yep.
Okay, but the rule of thumb, if you're going to do something like that, either for a grandparent or for a parent, we do have a kind of a format. So from age 0 to 7, just say you do $100 a month. Mm-hmm. From 7 to 12, you do $150, and then from 12 to 17 or college, you do $200 a month.
Right.
If you do that along the way, okay, on a policy, they will be able to probably borrow out $15,000 to $20,000 each calendar college year. Okay, stop paying it when they go to college. Okay, there'll be cash to take out to about $10,000 to $15,000, and then once they get out of college, the policy will still be alive because there'll be cash still growing.
Right.
And then you can hand it over to your college grad when he gets a job, or you continue to pay. Yep. And then just say in the next 10 years he continues to pay it, there'll be at least $25,000 to $30,000 for a down payment on the house, possibly, for them.
That's amazing. So it can be used for as many items as you can be creative about. Now, I know when my grandchildren were born, we started giving them $25 bonds 3 or 4 times a year for the holidays and whatever, amounted to less than $100 a year. I'm not so sure their parents didn't cash those bonds in when they came. I don't know where they went. I gave it to them. This is something you can be paying, they can know about, and you can feel good. Is there any tax benefit to buying insurance?
No, there isn't. Well, no. The reason why people will do it is one, they want to protect their family.
Right.
Protect themselves with our living benefits. life insurance does get passed on tax-free, okay, on a death benefit, okay? You borrow money out of a life insurance policy, it's tax-free, okay? There's no tax ramification at all. But again, there's different schools of thought on how to use it and why you use it these days, beside just a 25 or 10 or umpteen years ago when, like I said, the agent comes to the house to collect the premium.
Yep.
With a big long book ledger to say, okay, Joe paid, Rich paid, Sally paid, and
Right.
he turns the money in. A $25,000 policy today, you're looking at a minimum of 100 to 150, and even that's not a lot because people think that's a lot of money because they don't feel they'll never see that kind of money.
Right.
But a $100,000 policy will go pretty quickly.
So let's talk about the life of life, because that's a fascinating subject, especially now that I've gotten to be, I like to say 10 years ago I couldn't spell senior, now I are one. And I listened to Bob Weiss, who's the head of our hospital system in Hunterdon. By the way, if anybody hasn't heard, just announced he's going to retire. Wonderful gentleman. But he got up last year at a 65-plus evening we were having. It was for Linda Bryant, who set up most of our senior programs. And he was saying that in Hunterdon County, we have a lot of people that have outlived their money. They've also outlived their children, because one of the children had 50% of somebody else's bloodstream in them. So the one side lived and the other side might not have been so healthy. And they are tremendously active, lucid people with no money, and no people to take care of them at this point in time. And he said the most fascinating thing he said was, for every year we live, we have a year and a quarter more on our lifespan at birth, which means you're not going to live forever. It just means if you're born the first of this year, you're probably going to live a year and a quarter longer than if you're born the first of last year. He says, but to say it backwards is within 20 to 30 years, the average lifespan at birth will be over 125 years. That's an amazing number. I'm not sure, watching my parents and seeing some of our friends' end of lives, that those are really good quality years, but for some people they are. So we've really got to think about not only I make sure the kids have the mortgage paid till the mortgage is paid. Then I make sure they have money for college. Then I make sure they have money to buy their first house. At that point, the kids have gone through their 25th to 35th birthday and are buying the first house. They may still have 100 years left. And now, I'm not saying it's the parents and grandparents' mission in life to supply them with money for the rest of their life, but somebody should be thinking about it. And the quicker you get people into good habits like investing into the future, the better it's going to stick. I know Marilyn she puts her X dollars a month into the savings. And I say, where did you learn that? She said, my mother. My mother never made a lot of money in all her life, but every month she put so much into savings just in case. Today, I doubt if there's one person in 1,000 thinks that way. Most people are living 2 paychecks ahead of the Grim Reaper as far as financial disaster, and most people aren't putting away. And I'll give you a good example, millennials. 89% of the millennials are people that are 25 to 35 today in buying power. There's some younger yet. That 89% of them feel they want to buy a house. Yet only 5 of that 89% have put $5,000 away. Mm-hmm. They can't buy a house with $5,000 in assets. So even though they're convinced, they're still having the $8 coffees and the $12 desserts, and the money isn't getting put away. And I'll be the first to say they're not making what we used to make at that age. It's harder, there's less stock options, there's less bonus, it's a tougher environment, and we just came through 10 tough years of earning power. So we're seeing, for the first time, I think, in a long time, the economy is kicking in. We're seeing the results of the economy kicking in, and that car sales are through the roof, home sales are through the roof. The economy is doing so good, we're letting interest float. It's gone from just under 4% from the first of the year to about 4.7 right now. So that's 0.75% in, 6 months' time. But what they've done is they had a quantitative easing where the government would buy mortgage-backed securities to keep the mortgage rates down. Now they've eased the quantitative easing because the market is doing so well. They don't want to see inflation. They're saying the market can stand on its own. And not rumor, but forecasts say we'll be probably in the 5.5% mortgage rate by this time next year, which is still relatively cheap by some of the standards. Some of us remember when Jimmy Carter was in the office, we were paying 18, 19, 22% for mortgages. Mm-hmm. So 5.5, 6 is not bad, but it's not as good as 4 and 3/8. 3 and 3/8 was a year and a half ago. So we got spoiled. So I think the things that we've got to consider when we're looking at financial planning are, A, while the sun is shining, you got to put a few nuts away because winter will come. And number two, winter could be a long winter. It may not be. We used to get to 65 and we'd spend 8 or 9 or 12 years in retirement. It was over. Now we probably work till, I'm in my 70s, I'm still working. We get in somewhere along the line, we take a retirement and we've still got 30 years to go and we're retiring later. There's a lot of nuts better be put away, and those are going to be tough years for you. And if they're not for you, they're going to be for the surroundings, like Hunterdon County, for example, where what Bob's whole message was last year, we owe these people. They've lived with us all their lives, and now they need us, and we have to find people like Linda Bryant to put programs together so that they can get what they need. And Linda told a beautiful, touching story in that when she first came up as a nurse and was in her 30s, this woman was her mentor, is now one of her 85-plus-year-old clients that she takes care of with some of her programs. So it's sort of payback. And I think these programs are fabulous. So Rich is with Reliable Financial. It's reliable-financial, Rich Cohen. We're talking about Index Universal Life. His phone number is 973-641-6840. And his message here is you want to own your own insurance. What other products do you have that people may not be aware of?
Well, we do have what we call final expense, which are just smaller policies for funerals. People will buy those just to have a separate policy, just to earmark it for that.
Right.
For that reason. We also do fixed indexed annuities. We have, again, it's all different types of life insurance programs. I also do college funding. I help people find the right school. If you're a freshman or sophomore, you're not thinking of it, but hopefully your parents are starting to kind of earmark you, and the school is saying, what schools, what are you looking to do? Where would you like to go? And we try and fit the child, the parent, the school, and finances into one. So I also can help you find the best scholarships and grants that will help both of you, not just your child, but the big thing is, can the parent pay for the college we don't want to go? So that's something else I have in our agency. Like I said, we can help. We work with small business owners where we can help them with SEPs. We can help them with simple IRAs. Help them show the business owner, if it's a mom and pop shop and you're it. And what happens if you can't run it? What happens if you can't go to work one day? Are you going to count on your employees to take care of your business the way you have all these years?
Right.
So that's why we talk to them about living benefits, about putting money away for yourselves. We have a lot of our agents are working with small mom and pops like I am and showing them a way of, they have money into an IRA or into a SEP, but it's in the market. There's no downside. They're in mutual funds. They're great on the way up, but there's no stopping it until it gets to zero. So our plans, there is a bottom. There's a floor. Every year you earn, that's your floor. It's a ladder. It's a step ladder. Every time you earn an interest each year, that's where your bottom line is. Okay? And especially with the living benefits and in the Index Universal Life, it's one big package for a small business owner that will protect them for retirement, protect them for critical and chronic in case they can't run their business, for 3-6 months or a year. What would you guys do if someone in your family couldn't work for 6 months to a year or longer? do you have enough in your savings? We're supposed to save, what, 6 months for, for emergencies?
Right. Remember those rule of thumbs.
But that doesn't, 6 months goes by quick.
Right.
And that money's gone quick because mortgages are bigger. You got credit cards, car payments. Before you know it, that money's gone, and then what? Oh, I should have taken that policy from Rich with the critical and chronic care. Well, I don't force people. I show them what that's out there and will fit their needs and their budget. I won't oversell anybody or have anybody buy more than they can afford. I'd rather you buy less now, and we can always add on to it. The beauty about our programs, for the most part, about 95%, there's no blood work, there's no physicals. No one coming to your house and poking and prodding you to take blood, where some people are afraid these days. Once in a blue moon, I do need to have a client take a paramed, blood and urine. As long as they're okay with that, that's fine. And at that level, you're talking about $500,000, million, and plus. And we have carriers that will go up to $1 million as long as you're healthy and everything fits in line. The insurance companies nowadays are getting a lot smarter and know that the clients don't like doing the blood and urine sometimes. So they have new algorithms where if your height and weight, your medications are in line or none, I can get someone approved within, not hours and days, some of our carriers. So it's a lot simpler these days. Don't have to wait 6 or 8 weeks to go through underwriting, and it's very simple.
So what about someone who's been really good at putting little nuts away? They either had a 401 or a SEP or a retirement plan at work, and they put money away religiously, or it got taken out of their check and there was a match to it, and it was invested where it grew, and they're getting ready to retire, and there's a sizable lump of money sitting there. And they realize that's all they've got once they retire. I mean, I had our friend Fred Sade on a couple of weeks back, and there's really 4 streams of money you've got. Is whatever cash you may have coming in, maybe it's the rentals you own, there's your stocks, there's your unemployment, not unemployment, but Social Security, and then you've got whatever it is you've put away in this nest egg. And his whole thing was, which do you take first so you get the best tax advantage? But that's the only 4 places you can get money from. And I got to gamble that most people don't have any cash-producing investments when they retire, very little, if any. So it's mostly whatever you own, whatever your Social Security is, and whatever you've got put away.
Sure.
So now, person's done a really good job of putting money away, and I realize this is a different business than yours, but I want to ask it in the context of yours. And let's say they let's say they accumulated $1 million in their 401k. It's time to retire. Do you have plans that help that $1 million last longer, or is that a different business?
No, we do. What we do is, again, if someone can, save up that much, that's fabulous. No matter what they save up, what we help people, they have to. Some people, when they retire, leave it with the company in their 401k.
Right.
And first of all, foremost, there's always fees that's with someone's 401k.
Right.
Yes, you might be getting, they may match, and not everybody matches these days. The max is 3%, if that, or you got to put in whatever you put in, they'll match 50%. So it's not like it used to be. And when people put, they don't see the fees coming out. Of course, there are a couple of dollars here, a couple of dollars there. But again, going back to one of my clients, he had a savings account with X company. I'm not going to bring up the name. And I was looking at his statement, and I asked him, "There's 2 fees for $36 a month." And I said, "John, what are these?" He goes, "Rich, I have no idea. I've seen them my whole career."
Yeah, right.
We called up, and they're charging him a $36 fee. Not the company, but the managing company, because there's a third party that manages the 401k. So that's $72 a month, $960 a year, over 40 years.
Wow.
If you take the rule of 72, and your money should double every 7, So just say it doubled every 10, he should have been a lot well off than he is.
Yep.
So he lost a lot of money. People don't know about these fees internally because they don't really, they don't look at their statements. Maybe once a year when it comes tax time. You know, I go into people's homes and they pull out their 401k and the envelopes aren't open yet.
Yeah.
And it's 6 months or last year's. So we help them when someone retires, they should take their money and they can put it into something fixed, a fixed indexed annuity. Okay, yes, it's still, you know, but Rich, it's still in the market. You're right. But the key word there is fixed. So whatever you transfer over, you can't lose. You know, people, you know, think it's so bad about a fixed annuity. It's not. You know, they're run by insurance companies. There's the insurance companies that we use and I use are only all A plus and 100 years old. Our oldest is 169. A plus rated. They got bumped up from A to A plus during 2008 and 9 when everybody was looking for bailouts. They're pumping themselves up, and it's just people are, you know, no, I'll wait a little bit longer. Well, once the market starts to tick down, my phone doesn't stop ringing off the hook, and say, help me transfer it now, transfer it now, transfer it now, and you know, we try. So yes, we do have, when someone retires, take the money, move into something that's fixed, take it out of mutual funds, because there's no downside. Yes, we're still possibly in the market, but there's it's fixed. And yes, can we last longer? We have income riders. We can get a bonus when you transfer the money to pay in the carrier.
And can that typically be rolled over, like they're saying, roll over your 401k? So
yes,
there's
we
no
can roll
tax.
over.
It's still untaxed till you start to take it.
I know. Very, very rarely do I tell anybody to take it out and give it and send it to them.
Just
It
roll
goes
it
from institution to institution. This way, there's no tax ramification, no paperwork on your side, except an application that we fill out. I handle all the paperwork. I make all the calls. And so there's my companies. And in worst case scenario, I may have you do a conference call to have you agree with some you know, companies that need to talk to the client. But for the most part, it's seamless, very easy.
So I think we learned a lot here. We talked about the index life. We talked about fixed index. We talked about maybe the one thing I would like to leave behind is if you're having a grandchild, day one is the day to start investing in that grandchild, because a little then is going to add up to a lot throughout their life. And then when you finally get to retirement, there's a lot you need to consider. And it takes, by no means, I'm a real estate agent. I cannot give you financial advice. I always have to say you have to talk to your financial advisor and your tax accountant. I can tell you how I think things work, but I can't give you advice. And Rich is one of those people that you may want to talk to. Once again, his contact information is Rich Cohen, phone number 973-641-6840, and his company is Reliable Finance, with a hyphen. It's reliable-finance.com. And I'm just looking to see what we've got left. We've got probably about 5 minutes left. What haven't we got around to talking about that you would have liked to have talked about when we sat down?
Well, my thinking that, you know, people say, oh, I don't need life insurance, or when you're, like you said, when's a good time? When I'm young.
Yeah.
Now, you know, they think that I'm in my late 20s, early 30s, I'm not going to die, I'm not going to get hurt. That's the biggest misnomer, because it'll happen to anybody these days.
Right.
Like I said, I can take at least an hour and tell you a half dozen stories of clients, okay, of ours, of mine, that something happened to when they were young. So it's just think for the future. You know, if you want to get into a program like this, start when you're young. I can tell you, when I was a senior in high school, an insurance agent came to my apartment. I bought an index universal life plan. It was $50 a month. And a couple of years later, I didn't keep it. I wish I did, because if I kept it, I'd have a nice little retirement nest egg.
Yep.
You know, so it's not, like you said, like you said, your wife puts away every month.
Yep.
That's what you should be doing. This is what this policy, any of our policies can do for you. Protect your family, protect your future. And because, well, you never know. If you don't buy it now, and what happens in 5 years, 6 years, or a year, and you can't get insurance because of, God forbid, you come down with any type of cancer, God forbid, or heart attack or stroke. It can happen to anybody. Like I said, I've got stories, but It's, I don't want to sit here and tell, all morbid stories, but it does happen to anybody these days, not just when you get older.
And people get really confused. They say, oh, I have a friend that is a college professor, PhD, and when you turn 65, you're supposed to start taking your Medicare. You got to sign up for Medicare Part A anyway. And then if you've still got insurance, you don't need to buy anything because that lasts till you do retire. And then Medicare Part B is a policy for the hospitals and whatever, and that kicks in and they take it out of your Social Security when you start to take it. So things I learned along the way. He said, well, I don't need to do that because we did away with pre-existing conditions. I said, no, on this policy they call Obamacare, they did away with that. We're talking about Medicare. They're mutually exclusive. They never touch. And you've got to understand that if you at 65 don't have a problem, and when you finally want to go get this coverage at 72, if you haven't signed up for it and the problem has come along, that has nothing to do with protecting you anymore. So you really need advice as you go through those years. And I got to tell you, Social Security and Medicare and supplemental policies in Part A, B, C, D, E, F, G, they're confusing. I don't care what they say. Go to our site and 1-800.gov and you can't figure it out. You need a consultant. And that consultant, and I'm sort of off on a tangent, but I'm going to come back, usually isn't going to charge you a penny. He's an expert. He or she is an expert in this area and can show you what your options are and help you figure out the same thing. So when you are at that same point in time and you're trying to figure out what to do with the money you have accumulated, be it in a 401 or in private stocks, you need to talk to someone like Rich who can help you say, here's what your options are. You may not want to do any of them, but at least you know what they are. And he's an expert because he does it all day long and you do it once in a lifetime. And I know I can't remember what I do on the computer once a week. So it does take a certain amount of expertise, and that expertise usually isn't going to cost you any real money because that person who helps you, if you wind up choosing him, will make some amount of money off of the products that you buy, and that's how he or she earns their living. And there's nothing wrong with that. We all earn a living. So it's been good having you on. I think the one thing I would say as a grandparent, when I watched everybody giving the kid big stuffed toys, and I said to them, I don't know where those toys are going to be a year from now, but if I start giving them bonds, I know where to, hope I know where to. I'm sorry I didn't put it more into an investment policy like this that could have been used during school, could have been used during
Absolutely.
marriage. That's a great way to get started, and I know I've had other people talk about it when they've been on as well. Rich, where do you live? Are you local?
I actually just moved down to South Jersey, but my business is still up here. I have a lot
Okay.
of clients.
And your offices are where?
My office is either in Bridgewater or Cherry Hill.
Okay.
So I
Good.
do have two offices, and I normally go to my clients' homes and sit down with them on a one-on-one basis.
That's interesting. So if you'd like Rich to sit down and talk about anything of the things that we've talked about today, or if you've got something on your mind and we haven't covered it, he could be reached at 973-641-6840. And Rich Cohen would love to hear from you. My name is Joe Peters. I do residential real estate across Hunterdon and Somerset. And I've met Rich at a group I belong to in Somerset County, invited him onto my show, and I met his wife, or is it
Significant other.
significant other, because I have a significant. Marilyn and I have been together 28 years, we never got married. It's like, it ain't broke, why fix it?
Exactly.
And so I understand. And I met her, and she does real estate and flipping and things like that
Yes.
too. So that's
Investor side.
quite interesting. So I'm going to play my commercial one more time. We're going to sign off, and we'll be back next week when I do my monthly update on what's happening in Hunterdon and Somerset County real estate-wise. Rich, thank you for coming on.
Thank you.
One of the biggest decisions in your lifetime is buying or selling a house. Choosing a realtor with strong client communication, technology,